Let me just say the quiet part out loud. Right now, as of this month, the national average savings account in the United States is paying you 0.59% interest annually. That is the number. Not a worst case. Not an outlier. The average. Inflation, as of March 2026, is running at 3.3%. You do not need a finance degree to see what is happening here. Your bank pays you 0.59%. Prices go up 3.3%. Every single year you keep money in that account, you lose roughly 2.5 to 3% of its real purchasing power. Not in a crash, not because of anything dramatic, just quietly, automatically, because you did what responsible people are supposed to do. You saved. Now here's the part that really gets under my skin. This did not happen by accident. When the Federal Reserve started hiking interest rates aggressively in 2022 to fight inflation, banks raised their loan rates almost immediately. Your mortgage rate, your car loan, your credit card, APR, all of it went up within weeks. Their deposit rates, the rates they pay you, moved slowly, partially, and always later. Then, when the Fed started cutting rates again in late 2025, the loan rates held as long as possible. The Fed made several rate cuts in late 2025, favorable for borrowers, less so for savers, and deposit rates at the big retail banks dropped almost overnight. If you noticed your savings account briefly flirting with something that felt like a decent return over the last couple of years, and then watched it slide back to almost nothing, that was not bad luck. That was the business model executing perfectly for the bank, not for you. And then there are the fees. Because of course there are. Consumers paid an estimated $12.1 billion in combined overdraft and NSF fees in 2024. $12 billion. From people whose accounts briefly went negative, often by amounts that are almost embarrassing to calculate against that fee. JPMorgan Chase charges $34 per overdraft. Wells Fargo charges $35. U.S. Bank charges $36. JPMorgan alone collected $1.028 billion in overdraft fees in 2024. And here's the detail that bothers me most. About 9% of checking accounts are overdrawn 10 or more times per year, and those accounts generate approximately 79% of all overdraft and NSF fee revenue. 9% of accounts, 79% of the revenue. The same people, over and over again. That is not a penalty for bad behavior. That is a revenue stream built around keeping a specific group of customers exactly where they are. For a moment in late 2024, it looked like something might change. The Consumer Financial Protection Bureau finalized a rule that would have capped overdraft fees at $5 for large banks. $5 instead of $35. The estimated savings to American consumers, $5 billion a year. It never took effect. The Senate voted 51-47 to repeal the rule in March 2025. The House followed in April. President Trump signed the repeal on May 9, 2025. The rule was permanently nullified before a single consumer saved $1 from it. So the regulatory protection that millions of people were counting on simply does not exist. ATM fees hit a record high of $4.86 in 2025, the third straight year of records, quietly, without much coverage. Meanwhile, JPMorgan reported a year-over-year increase in overdraft fee income of 7.66% for the first 3 quarters of 2025. Citizens Financial reported a 16.9% increase over the same period. The fees are going up. The deposit rates are coming down. The regulation designed to protect you was repealed, all in the same 12-month window. Now, I want to be fair here because the picture is not entirely bleak. The best high-yield savings accounts are paying around 4% APY right now. Online banks with lower overhead have genuinely better rates. If you are willing to move your money and do a bit of research, you can actually get close to keeping pace with core inflation. But here's the problem with that. Most Americans are not doing that. Most Americans have their money at the same big retail bank they opened an account with in college or in their 20s, earning whatever that bank decides to pay them, which is currently about half a percentage point. The national average interest rate on savings accounts is a baseline, not a ceiling. Online banks operate with lower overhead and use competitive rates to attract deposits, which is why the gap between the national average and the best available rates remains wide. For most savers, switching accounts is the single most effective way to earn more on cash. The option exists, the information is available, and yet the default, the account most people never think to question, is the one designed to benefit the institution. None of this is a call to panic. The banking system is still the infrastructure of modern financial life. You are inside it whether you like it or not, and dramatic exits rarely help anyone. But there is a real difference between using a system and understanding what it is actually doing to your money while you are distracted by everything else. Your bank account was sold to you as a safe place, a neutral container, somewhere your money waits patiently, protected until you need it. Since 2000, consumers have paid a cumulative $280 billion in overdraft and NSF fees alone. That is not a rounding error. That is a business model. And it has been running quietly in the background this whole time. So the next time you glance at your savings balance and feel vaguely okay about it, ask yourself one honest question. Okay, compared to what? Because your bank knows the answer. They just are not going to put it in the app.